Right, this might not be the most thrilling video I've ever made. I mean, we're going to be talking tax. But if you're a landlord or looking to be a landlord, I think it might just be one of the most valuable. Someone actually left a comment on one of my most recent videos. They're already a landlord and they asked how I managed to reduce the tax bill on my latest buy-to-let. And that's part of what pushed me to make this video, because tax has quietly become one of the biggest costs in property investing over the past few years. Now, I'm not an accountant and none of this is financial advice, but I have run this past my accountant, and as of July 2025, he's happy with what I'm saying. And everything here is based on HMRC's own rules anyway, so there's no clever dodges or loopholes. So I'll walk you through the key taxes that are affecting landlords right now, what's changed, what people often miss, and some practical strategies that might end up saving you thousands of pounds. And I'll come back later to a real example of how one landlord I know of practically wiped out a £4,000 tax bill with one form and a £200 solicitor fee. Okay, so let's get started with what's changed for landlord tax bills here in the UK. Over the last few years, the government has made it harder and harder for landlords, like myself, to turn a profit. I'm not going to get political, but it has been tough. Section 24 was first introduced in 2017, where mortgage interest relief has been increasingly restricted up until I think 2021. You now only get a 20% tax credit, which often pushes landlords owning property in their personal name into those higher tax bands. Stamp duty has also been increased, with the latest hike being super recent. So if you're buying through a limited company or it's an additional property, which is typical for property investment, you now pay a 5% surcharge, not the 3% it was before. And also from April 2025, just gone, the furnished holiday let regime is being scrapped. So no more capital allowances, no more full mortgage relief, and the 10% capital gains tax rate has gone up. And look, if the government's squeezing us landlords with all of these changes, we've got to squeeze back by using every break and rule that we legally can. Emphasis on legal there, so no grey areas. But that's why it's worth understanding the rules, because once you know what's possible, you can start making them work in your favour. So let's first talk through some of these rules from the perspective of personal ownership, which is owning property in your own name. Well, first up is income tax on rental profits. Any rental profits that you make in your personal name gets added to your salary, your dividends, everything. So the basic rate is 20%, then 40%, and then 45%. But before 2017, before Section 24, mortgage interest was fully deductible. So now it's just that 20% tax credit, and it's applied after your profit is calculated. So even if you never see that tax money in your account, the taxman still takes his cut. And that bumps many landlords into the higher tax band for their personal income, which is a bitter pill to swallow for most. So next is capital gains tax, or CGT. When you sell a rental property in your personal name, you'll pay at least an 18% capital gains tax rate if you're a basic tax rate payer, or 24% if you're higher rate. At least this went down last year from 28%. But a good thing there is you can also deduct buying and selling costs and any capital improvements, like a new kitchen or an extension. And also if you ever lived in the property yourself, you might get some private residence relief, including for the first 9 months of ownership, I think. But the third is a big one, stamp duty land tax, or SDLT. And any experienced investor has paid a lot of SDLT. Stamp duty is now even higher if you're buying an additional property or you're a non-UK resident. But if you're a first-time buyer and occupies your main residence, you can still claim relief of up to £425,000. So that could save you thousands on SDLT. And it's brilliant if you're looking to get started. A lot of the new property investors that I speak to recommend this as a way to get into property. So you can start by doing a live-in refurb or a live-in flip, and it just gets you on the ladder. I talk about that up here a bit more on how to get started with just 10k, so click that if you're interested. So that's the main tax situation if you're buying a property in your personal name. But what about if you're buying it through a limited company instead? Well, buying through a limited company has several major advantages. You do get that sweet full mortgage interest relief, so it's great if you're already a higher taxpayer like myself from my full-time job. Capital gains tax also don't apply to limited company ownership. Instead, the company pays corporation tax at 19 to 25% on a sliding scale, depending on profits. Third is that you can deduct extra costs like pensions, part of your phone bill, tools and laptops, away from your profit, as long as you're using them for genuine business purposes. And if you're VAT registered like I am, there are some VAT costs that you can claim back. But be careful with that, and I'll explain why shortly. But it's not all rosy for limited company ownership. On the other hand, you've got stuff like paying that extra 5% stamp duty and slightly higher mortgage rates because the bank sees it as more risk. It's also harder to manage, and you'll need to submit annual company accounts. And if you need to actually take money out the business for your own pocket, you'll need to do it via salary, dividends, or pensions. But there's no one-size-fits-all answer to personal ownership versus company ownership. It really depends on your income, your goals, and how many properties you want to build up. If you're not sure which route makes sense, I've done a full video comparing personal ownership versus limited company ownership, using real numbers based on different income levels. I break down what each approach actually costs, so I'll link that up here if you want to dive into it. Alright, final section of the video, and probably the most useful. How can landlords actually save money? Well, here are a few totally legit HMRC-approved ways to cut your tax bill, depending on whether you own in your personal name or through a company. So let's start with personal ownership first. If you own a property in your personal name, you can claim all allowable expenses to reduce your profit. So that's letting agent fees, maintenance, insurance, mileage, phone use, small tools. Confirm these first with an accountant though before you go wild just claiming everything. You can also get renter room relief. So if you live in the property and you rent out a furnished room, you can earn up to £7,500 tax-free for a lodger. And here's a final brilliant one. You can split the income with a spouse using a declaration of trust and Form 17. Which is especially helpful if you or your partner isn't using their personal allowance already. Maybe they're a full-time parent instead. So remember that landlord I mentioned at the start. They were a higher rate taxpayer, earning decent money, renting property in their personal name, and then Section 24 from 2017 was killing their profit. But they got advice from a professional, paid under £200 for a declaration of trust via a solicitor, submitted Form 17, and moved the rental income to their spouse who wasn't earning. Their tax bill dropped to zero because it was within their personal allowance, and there were no tricks, it was just a bit of planning and the right paperwork. So if you're in a similar situation where your spouse isn't earning and you're paying the higher tax rate, then speak to an accountant as soon as you can, because it might be able to save you thousands too. But that's personal ownership. On the other hand, if you own property in a company like I do, make sure you're claiming all allowable expenses as well, especially if you're VAT registered. So any deductions and legitimate expenses, keep receipts for everything, even the fuel you use, the laptop, internet connection that you need for the research, and even part of the electricity bill. All of that can potentially be at least partially deducted, as long as you're using it for legitimate business use. Also, definitely use your pension contributions. It's boring to think so far ahead, yes, but it reduces your corporation tax and helps you build for your future. And then know that you can carry losses forward or back over the tax years, so you can offset profits in other years if your company runs at a loss. And then, just like personal ownership, you can use up the personal allowances of yourself and your spouse if they're available. You can register a spouse as an officer or an employee for the company, let them contribute some meaningful work, and then you pay them a salary. So that wraps up how landlords can save money. But let me quickly circle back to that comment I mentioned at the start about how I kept the tax bill low on one of my recent buy-to-lets. As most experienced landlords will know, buy-to-let rent is VAT exempt, but the materials and labour you pay for it are charged at the standard 20% VAT rate, because the output, the rent, is exempt. So you usually can't reclaim that as input VAT. Hopefully that made sense. An accountant can explain it better than I did. But basically what I'm saying is you can't claim back VAT on materials. However, the property that I just finished had been unoccupied for quite a while. So I qualified for the reduced 5% VAT on labour, but also the total spend luckily fell under the HMRC's de minimis threshold, which meant I could recover a portion of the VAT, even though the rental income is typically VAT exempt. And as I was saying earlier, because I run a VAT registered limited company, I can also reclaim some VAT on tools, materials and software that I use across all the projects under HMRC's partial exemption rules. So that won't apply to most buy-to-let setups, but it's a perfect example of why it's worth running things by an accountant before you start the work. Whew, so that was a lot of tax talk, and hopefully you're still with me and not asleep at your desk. I know this stuff isn't always exciting, but honestly, if you want to invest in property, understanding tax is one of the most important things that you can do, because it's how you maximize your profit. If you found this video useful, please subscribe to not miss my future posts. And I've got more videos on a bunch of property topics, such as buy-to-let basics, that I'll show over here somewhere. Thank you for watching, and I'll see you in the next one.